They told us Lehman Brothers collapsed because of risks no institution could survive. That explanation is not wrong, but it leaves out the most disturbing part. Months earlier, the system had stepped in to prevent another bank from falling. Only days later, it stepped in again, saving an insurance giant from collapse. One institution was supported. Another was rescued. But this one was allowed to die. Why did Lehman become the one failure the system was willing to accept? Every crisis leaves behind two histories. The first is written after the damage is done. But the second history is harder to find. It exists inside meetings that failed. This is Case File 1. Lehman Brothers. Why was this bank allowed to collapse? Not how it collapsed, but why this was the one they chose not to stop. The familiar story always begins with a house. For years, rising prices made risk appear temporary and debt appear safe. Mortgage lenders issued more loans. Those loans were sold, pooled, and transformed. Securities could move through the financial system far beyond the families who signed them. As long as homeowners paid and property values climbed, the machine generated profit. So the machine demanded more mortgages, more securities, more debt. More borrowed money was used to purchase assets whose safety depended on rising prices. Lehman Brothers became exposed. When payments failed, these assets became difficult to value. Delinquency rate up 40. Jesus Christ. This explains why Lehman was in danger. But why was it allowed to fail? A bank doesn't die from losing assets. It dies from running out of time. Lehman still owned buildings, securities, and loans worth billions on its balance sheet. Every day, the institution depended on short-term funding from lenders who expected repayment. As confidence weakened, those lenders demanded more protection, securing less money with assets. Lehman tried to sell assets, but the market offered far less than reported value. It tried to separate troubled real estate, but the underlying risk remained connected. From the street, the lights remained on, and the institution still looked alive. But survival in modern finance depends on a collective belief that obligations are met. Once that belief disappears, counterparties do not wait. They stop renewing credit. If the bank was running out of time, why did leadership believe help was coming? 6 months before Lehman collapsed, another investment bank reached the edge. Its funding disappeared. Counterparties pulled back. And before markets could reopen, officials faced the possibility of a disorderly bankruptcy. This time, they did not allow the institution to fall alone. A buyer was found. But the buyer would not accept the most dangerous assets without protection. So an emergency structure was created. The operating business moved to a stronger institution, while a separate pool absorbed the unwanted assets. The immediate failure was contained, the market opened, and the system survived another Monday. But every rescue teaches the market how power will behave during the next crisis. Inside Lehman, the earlier rescue became more than a historical event. It became a possible template.
We follow the same risk isolation structure.
Yes, it creates precedent. Are you sure? Expectations are built from actions. If conditions became desperate, perhaps another buyer would be found. Did Lehman misread the precedent? Or did the system send the wrong signal? We now transition to September 12, 2008, outside the Federal Reserve Bank of New York. The final obstacle was not the absence of interest. It was the absence of protection. A potential buyer could see value in Lehman's businesses, but could not assume unknown losses. Someone had to bridge the gap and guarantee that the buyer would not inherit a collapse. That protection never arrived. Officials could provide emergency liquidity, but could not accept unlimited losses. Emergency loans still required collateral whose value could be defended under rigorous institutional rules. And Lehman's most dangerous assets were dangerous precisely because no one could agree on valuation. Private banks offered pieces of a solution, but each institution wanted to limit its exposure. That left the government, where legal and political questions blocked another open-ended public rescue. The private sector waited for the government. The government insisted the industry find the answer. Did officials lack the legal authority to rescue, or did they choose not to intervene? A buyer required protection. By Sunday night, the result was unmistakable. The unsigned public guarantee led straight to bankruptcy. Lehman filed for bankruptcy before markets opened. That decision could not be reversed. But the market's response was only beginning. Banks reduced exposure. Money market funds faced redemption pressure. Companies held on to cash instead. Collateral demands increased everywhere. Each institution simply protected itself. Together, they removed liquidity from the system faster than anyone expected. Confidence disappeared because every institution questioned if the next might fail. Within 48 hours, the crisis no longer belonged to Lehman. It was systemic. Only 2 days after allowing one collapse, intervention returned to prevent another. If allowing failure protected discipline, why was another rescue necessary immediately? The answer lies in what officials learned, because Lehman had already fallen. Was Lehman a necessary sacrifice? Phase 7. The sacrifice hypothesis. After the crisis, one interpretation became difficult to ignore. Perhaps Lehman was allowed to fail because the system needed an example. Months of emergency intervention had created a dangerous expectation. Every rescue reduced immediate panic but strengthened the belief in future support. Officials worried about moral hazard. If risk wasn't priced honestly, a line had to be drawn. Lehman appeared on the wrong side. Its credibility had deteriorated. Protecting it publicly would have been difficult to explain after months of increasingly controversial intervention. The system needed to demonstrate that failure was possible. Officials believed that many market participants had time to prepare for it. What proved harder to predict were indirect consequences: client assets trapped, money market redemptions, and the sudden hoarding of cash. Lehman's failure triggered a collapse of trust between institutions. No firm could know if it would be protected next. Lehman may have been expected to fail without bringing down the system. That is different from choosing to create disaster.
You knew the potential cost of that decision, didn't you?
We considered many factors. Officials wanted to restore limits to intervention, but they clearly underestimated the consequences of an uncontrolled bankruptcy. The system decided to test market discipline without fully understanding the very market it was testing. Lehman was an investment bank, but that description hides what the institution had become. It borrowed short-term money. It financed long-term assets. It held client cash. Every contract appeared protected, but every protection depended on the rest of the chain functioning. To the law, it was hundreds of separate companies. A client might see cash on a statement. Here, a different story. But the legal right to release that cash belonged to another subsidiary in another country. The market diagram showed one network. The legal table divided the network into isolated claims. The market could dismantle the institution faster than the legal system could even begin to understand it. There was no established mechanism for closing a global investment bank while preserving its critical functions. The collapse did not reveal that every institution was insolvent. It revealed that no one was certain. Lehman was the trigger. The deeper failure was architectural. The system could create connections faster than regulators. It could remove trust faster than any authority could restore it. That is what actually broke. What did the system believe would happen next? Revelation, the decision that changed the rules. The evidence does not reveal a single order to sacrifice Lehman. It reveals something more complex. Lehman was already failing. Its funding was disappearing. Its assets were difficult to sell. Buyers wanted Lehman's businesses, but not the uncertain losses attached to them. Losses had to be held somewhere, but neither the buyer, banks, nor government would agree. Officials feared another rescue would confirm that every large institution was too important to fail. Lehman reached the edge when authorities tried to prove a boundary existed, based on one assumption. The failure could be contained. That was the assumption that failed. Lehman's collapse did not remain. Lehman died between several decisions: delays, refused losses, legal limits, and underestimated risks. Officials believed the system could survive without saving it. They were proven wrong by the aftermath. After Lehman, no government could assume letting one institution fail would affect only that bank.